Hey everybody, welcome to your weekend review for the week of Monday, December 5th, 2022. And oh, what a week it was. Bonds were tough early. Bonds were down 25 basis points to start the day on Monday. The services economy improved in November according to the ISM Services Index. The business activity component increased by 9 points, which is pretty bullish for this economy. Supply chain issues continue to abate. Prices continue to be firm, although the number of firms that reported increased prices did actually decrease slightly. This reading and illiquidity in the market led to many drops throughout the day. Without a lot of people participating, smaller trades can move the market quite a bit. While the manufacturing economy seems to be in contraction, the services economy is getting better. I suspect that the US dollar strength is playing a part in this, and as the Fed wraps up its tightening regime, the dollar will weaken. Bonds got off to a weaker start as the new week for a variety of factors. Over the weekend, a few Fed pundits shared more hawkish outlooks, including the Wall Street Journal, which pointed to some news and some opinions from people that it's actually going to take much more tightening out of the Fed in order to stifle inflation. Markets already heard the Fed say the same. But the absence of news, it really mattered. And like we said, with a lack of liquidity, it moved the market a little bit more. There's also some prospect of easing COVID restrictions in China. The bigger story was a slight pressure on bonds heading into the domestic session. Either way, it was stronger ISM data that did most of the damage, touching off a selling spree that took MBS roughly 3/4 of a point lower. At the end of the day, we were down 67 basis points on the day on the MBS, and the U.S. Treasury was up 10 basis points. This put us into a very wide range with a overhead resistance at 102.788 and a floor at that 100-day moving average. Then on Tuesday, bonds began the overnight session with treasuries moving higher amid a rally in Asian equities. Generally weaker data in Europe pushed the market back to a risk-off direction. 10-year yields hit domestic session a few basis points lower and rallied at the 620 CME open. Since 6:30 in the morning, bonds had been losing ground, now about 1 basis point off when we started our day here on the West Coast. UMBS were down 17 basis points on the open. Contracts on S&P 500s wavered following a third day of declines on the index on Monday. Futures on the NASDAQ 100 fluctuated in a narrow range. A gauge of European equities turned lower as a 7-week rally lost steam. A resilient U.S. economy and sticky inflation are countering optimism about reopening in China, with money market futures and economists suggesting the Fed will need to push rates higher in order to stifle this inflation. Home prices fell 2.4% quarter over quarter, according to Clear Capital housing data. It's interesting to see places like the Midwest and Northeast taking the lead, while the hottest markets on the West Coast are taking a beating. You can see some of the hottest markets here for taking declines are San Francisco, San Jose, Seattle, Denver, Portland, Dallas, Phoenix, Las Vegas, a lot of West Side places. Falling home prices are affecting builders as well. In November, 36% of builders cut prices to move inventory, and 56% are offering some sort of incentive. Stocks and bonds were moving after Chase CEO Jamie Dimon says he thinks the 10-year is going to be much higher before everything's all said and done. His predictions have been fairly shoddy over the last couple of years, although he does throw a lot of money around and therefore might have access to information we don't see. Spread between the 2-year and 10-year treasuries is now at 81 basis points, which is the most since 1981. If you look back at the graph, you'll see that 1981 was the start of a really bad recession. The most notable run of the day happened around 2 p.m. when Treasury yields had dropped fairly sharp. Caveat is this is also the same time yesterday's trading range, so it might be a matter of when traders are showing up to work and actually doing stuff. At the end of the day, we're up 14 basis points, which puts us back in the bottom end of that range we talked about, where the floor is the 100-day moving average at 100.985. Ceiling is 102.788. A very wide range like that is going to be bouncy. Wells Fargo also announced they are cutting hundreds of mortgage employees last week, citing a dramatic downturn in business. Envoy Mortgage slashed 30% of its workforce, which is bad. But Reverse Mortgage Fundy has declared bankruptcy. I heard about this last week from somebody that was looking to leave there. One of the interesting things about a reverse mortgage company going bankrupt is that the courts freeze their bank accounts, so therefore they cannot pay the monthly money out to a lot of retirees, which is a big, big problem. But apparently they got U.S. bankruptcy court approval today to resume payments to those borrowers, which is big for our older population. We also got a post from our sponsor at WellThatMakesSense.com, Commanders of Attention, the attractors. So these are all about the things that attract attention and can motivate people to buy even before they start a buying scenario. So definitely check it out at www.wellthatmakessense.com and learn how you can set up the environment and set up things before you sell to make you sell even better.